This video is going to cover the topic of assurance and how it relates to an external audit. We're going to cover the definition of assurance, the external audit, the 5 elements of an assurance engagement, and the levels of assurance that can be provided. When we give assurance, we are giving our opinion on something. Therefore, an external audit is an example of giving assurance. To define assurance, we are given the following. A practitioner evaluates a subject matter that is the responsibility of another party against a criteria to express a conclusion to the user of the subject. To help remember this definition, we will highlight the key words: practitioner, subject matter, responsible party, conclusion, and user. We can apply this terminology to what we know about an external audit to see how it relates. Our practitioner is our external auditor. Our subject matter is the financial statements. The responsible party is the client management. The conclusion is the audit opinion, and the users are the shareholders or other intended users. This definition applies to any other assurance provider also, for example, building surveyors for new properties, and by personalising the definition in this way, it helps remember the key terminology. By providing assurance, like the auditors provide assurance on the financial statements, you are giving confidence to the users when making decisions, and enhancing the credibility of the information in the financial statements. There are 5 elements of any assurance engagement. The 3 parties involved, the practitioner, the responsible party and the user. The subject matter. A suitable criteria which the subject matter is evaluated. Sufficient appropriate evidence. And a written assurance report. Therefore, for our external audit, the 3 parties are the auditor, the management and the shareholders. The subject matter is the financial statements. The suitable criteria is the applicable financial reporting framework used to prepare the financial statements. Sufficient appropriate evidence is collected by the auditor through the audit procedures carried out and review of the financial statements. And the assurance report is the audit report. Finally, we should review the levels of assurance an assurance provider can give. The IAASB tell us there are 2 levels, reasonable and limited. For reasonable assurance to be provided, the practitioner must provide sufficient appropriate evidence in order to form reasonable conclusions. This requires a high level of assurance to be provided, and so a high level of detail is provided in the practitioner's procedures. The practitioner will then issue a positive report or opinion. Therefore, our external auditor carries out thorough audit procedures to gather enough evidence which ensures an external audit provides reasonable assurance. The audit report is a positive report as it states that the financial statements are or are not true and fair. In comparison, a limited assurance engagement provides sufficient appropriate evidence in order to form limited conclusions. This requires a moderate level of assurance and a moderate level of detail required in the practitioner's work. The practitioner will then issue a negative report or opinion. Auditors may provide other services to their clients and may be asked to review information for them as a separate assignment. Therefore, to review something for a client requires less detailed work in comparison to an external audit. Also, when reviewing information regarding future events, for example a review of a cash flow forecast, it is impossible to give a positive opinion as we cannot predict future events. The wording is different in a negative opinion. Typically, the term "nothing has come to our attention" when reviewing is used in this type of report. To summarise this video, assurance is giving your opinion on something. External auditors are assurance providers. There are 5 elements of an assurance engagement: the 3 parties, the subject matter, the suitable criteria, the sufficient appropriate evidence, and the assurance report. And there are two levels of assurance that can be provided, reasonable and limited, with the external audit providing reasonable assurance. I hope you found this video useful. Thank you for watching. The aim of this video is to give you an understanding of the external auditor's role. The key areas to cover are understanding what is an audit, the expectation gap, the audit process, and the pros and cons of an external audit. An organisation has shareholders who invest money into the company, the directors who are then responsible for looking after that investment and reporting on how the company is performing, and the financial statements, which are prepared by the directors so the shareholders can see how their investment is doing, as well as other users to review for their own decisions. In order for the shareholders to feel reassured that the information they review in the financial statements is prepared properly, it is reviewed by an independent party on their behalf. The independent party is the external auditor. Our external auditor's objective is to review the financial statements and to form an independent opinion. The opinion has specific wording, and the auditor must communicate whether the financial statements are true and fair and properly prepared. This opinion is stated in the audit report. This is prepared by the auditors once all audit work is completed and included within the financial statements when presented. To define the term true and fair, we must first understand that the auditor cannot say the financial statements are accurate. The reason for this is that the external auditor does not review every single transaction in the financial statements, nor do they spend every day at the client's offices and production site observing every single process being carried out. The time the auditor has to complete an external audit means they should take a snapshot of the client's transactions and systems and controls. It is from this snapshot that they form an overall opinion on the financial statements. We say that the auditor reviews the financial statements on a sample basis, as they select samples of transactions to review rather than test them all. Therefore, when an auditor states that the financial statements are true and fair, they are saying that they are factual, they agree with the underlying records, clear, unbiased, and generally free from material misstatements. Material misstatements are errors within the financial statements that, if not corrected, could influence the decisions made on the information given. It is the auditor's role to identify any material misstatements within the financial statements so that they can be corrected by the client before the accounts are published. In terms of reporting on whether the financial statements are properly prepared, they are saying they are prepared in accordance with the applicable reporting framework. The audit report prepared by the auditor will therefore state whether the financial statements are true and fair and properly prepared. There is a misconception of the role of an external auditor. Many users of the financial statements believe the auditors test all transactions and balances. In fact, they test transactions on a sample basis. They believe that auditors should detect all fraud and error, when in fact it is the auditor's responsibility to report on whether the financial statements are free from material misstatements, whether caused by fraud and error. And many believe it is the responsibility of the auditors to prepare the financial statements. This responsibility always lies with the directors of the company, not the auditors. This is known as the expectation gap. Ideally, auditors wish to reduce this gap as much as possible to ensure everyone understands the role of the auditor. For the auditor to form an independent opinion on the financial statements, there will be considerable time spent with the client and reviewing the books and records. To ensure the work is carried out properly, the audit has a standard structure. This audit process can be outlined as follows. Step 1. Acceptance. The auditors must consider before they begin the audit work whether they want to accept a new client or continue the audit for an existing one. They should identify if there are any factors which could cause the auditors problems when working with the client. Step 2. Engagement. If they are happy to continue the external audit work, they will need to ensure an agreement is in place between the client and the auditor. This is known as the engagement letter. Step 3. The plan. Once the agreement is in place, the auditor must then carefully plan the audit and identify any risks and other issues that need to be managed during the audit. Step 4. Assess controls and systems. The auditor must then review the systems and control procedures at the client. The aim here is to identify whether they have strong controls or poor controls. This helps decide how reliable the financial statements may be and the amount of work the auditor should carry out on transactions and balances. Step 5. Substantive testing. This is the testing stage where the auditor performs audit procedures on transactions and balances within the financial statements to identify potential misstatements. Step 6. Completion and review. At this stage, the audit manager will review the evidence collected and the work completed to ensure it is enough to form an opinion. Step 7. The audit report. Finally, the audit partner responsible for the audit will review the audit work and the financial statements and form an opinion on whether the financial statements are true and fair and properly prepared or not. We must understand what happens at each stage of the audit process to fully appreciate the external auditor and the opinion that is formed on the financial statements. External audits are often not viewed fondly by many. The negativity arises for many reasons, but believe it or not, there are many benefits for having an external audit. Here I'm going to identify some of the pros and cons of an external audit to give the argument balance. The pros. By having an independent team review the financial statements, it means they are likely to spot any material misstatements, therefore detecting fraud and error. It enhances the credibility of the financial statements, so users of the information can trust what is given to help make decisions, for example, if looking to give finance for the client. It improves the quality and reliability of the information, which then improves shareholder confidence and the company reputation. Auditors can recommend improvements to systems and controls based on their experiences with similar clients. And their independent advice can also help resolve disputes between management and assist in better decision making from the management team. The cons. They do not test every transaction as they have to use a sample basis, so there could be misstatements in transactions that have not been seen by the auditor. Financial statements include estimates which are difficult to audit as they are subjective and hard to prove. The auditors may have to rely on evidence provided by the client management for some areas if external evidence cannot be obtained. Systems and controls have their own limitations, and the auditors rely on some information provided by these systems. Therefore, to summarise, an external audit is an independent review of the financial statements. There are 3 parties involved: the user of the financial statements, for example the shareholder, the provider of the financial information, the directors, and the external auditor performing an independent review. Auditors form an independent opinion on the financial statements and state whether the financial statements are true and fair and properly prepared. Auditors follow a standard process during the audit to ensure they form the correct opinion. An external audit has limitations, but they enhance the credibility of the financial statements and help improve confidence in the client's operations. I hope you found this video useful. Thank you for watching. This video has been prepared to help understand the topic of ethics. Ethics is an important topic for all accountants, as there is a huge focus on how they behave to maintain the reputation of the profession. Accountants should act in the public interest, and ethics is essentially guidance on how to behave morally and professionally. IFAC, the International Federation of Accountants, issued a code of ethics, which has been adopted by accountancy professional bodies. These ensure the right decisions can be made in any situation. One of the key pieces of information supplied is in the code known as the Fundamental Principles. Ethics is one of the key areas that auditors must consider when deciding whether they should accept a new client, or continue to act for an existing audit client. An auditor should not act for a client if it will affect their judgment during the assignment. To help remember the fundamental principles, we can use the mnemonic OPIC. We will go through each principle so you can understand the importance of each one. The O is for objectivity. Auditors must be objective when making decisions. This means they must ensure they do not allow bias or other factors to influence their judgment when making decisions on the audit assignment. If auditors remain objective during the audit, then they will be able to make an independent opinion on the financial statements. It is important for auditors to not only be independent, but to be seen to be independent by others. They therefore need to be careful not to be too connected to the client so they can maintain their objectivity. The P is for professional behaviour. Auditors must ensure they comply with relevant laws and regulations and act properly to ensure they maintain professional standards. At the end of the day, auditors are trusted to give an independent opinion, which is important to users making decisions based on these financial statements. Their opinion will only be taken seriously if they are regarded as someone to trust. The other P is for professional competence and due care. Auditors need to ensure that they maintain their professional knowledge and skill needed to do their work properly. They must also follow all relevant regulations, for example the auditing standards, in order to maintain the reputation of the profession. Auditors should not take on work they are not technically competent to do. Just because you have audited one company, it does not mean you can audit all. Each industry has its own regulations and niche reporting requirements that must be understood by the auditor, otherwise mistakes may be made. The I is for integrity. This is probably the most simple principle to define. Auditors should be straightforward and honest in all matters. Those relying on the information auditors provide need to trust them, but they also need to be able to understand the information being presented. Finally, the C is confidentiality. For the business to trust sensitive information being handled by the auditors, they must be able to keep information confidential. No information should be passed to third parties without authority, and length should be taken to ensure information is not leaked. Strong controls should be in place within an audit firm to prevent this from happening, such as passwords to access data, restricted access to client information, and training on the importance of confidentiality to the audit team. Therefore, no gossiping about clients. In summary, for ethical standards to be maintained, the 5 fundamental principles should be followed and applied. If auditors do not follow them, the opinion they make on the financial statements lacks the credibility needed by the users of this information. If the auditors feel that their ethics would be called into question when working with a client, they should decline the offer to do the work. If it's an existing client, then they should resign. I hope you found this video useful. Thanks for watching. In this video, we are going to talk about ethical risks relating to external auditors. The aim is to gain an understanding of the practical issues that auditors must consider relating to ethics at the acceptance stage of an audit. There are 3 main areas we need to cover here: threats to objectivity or independence, conflicts of interest, and breaking confidentiality. Each of these issues need to be addressed when they arise and considered at the acceptance stage of an audit to ensure they do not cause problems for the auditor later on in the audit process. Firstly, let's look at threats to objectivity. Objectivity is one of the fundamental principles given in the Ethical Code. We are told that auditors and accountants as a whole should remain objective when making decisions. They should not allow bias and not be influenced by others. However, During an audit, there are many situations where influences could be present, making it difficult to maintain objectivity. These are known as threats to objectivity. We can categorise them into 5 types of threat: self-interest, self-review, familiarity, advocacy, and intimidation. Firstly, we need to understand what each type of threat is. Then I will take you through some practical examples and how the auditor should manage them. A self-interest threat is where the auditor has a personal interest in the client, which could affect the decisions they make on the audit. This could be a financial interest or any other interest that could affect their judgment, which could affect the whole audit, including the opinion. A self-review threat arises where an audit firm may provide other services other than external audits to a client. Other services, such as tax and accounting preparation, could be completed by an individual who then goes on to work on the audit assignment. The issue is that if they were to audit their own work and discover an error, it would be unlikely that they would admit to it, thereby leaving a potential material misstatement in the financial statements. Familiarity threats are when the auditor is too connected to the client, which affects their reaction to things the client does. They can become too trusting of the client's actions, which can affect decisions made on the audit compared to other less familiar clients. Advocacy threat is where the auditors could be representing them in some way or promoting them. This could be seen as holding their hand and lacking objectivity needed to form an independent opinion. Finally, intimidation threat is where the client may put pressure on the auditors to threaten them in order to influence the outcome of the audit. If the auditor identifies any of these threats relating to one or more of their clients, they need to put safeguards in place to reduce the threat to an acceptable level. And so our next step is to identify some typical situations that auditors find themselves in relation to these threats and the necessary safeguards that you could recommend. Self-interest threats include owning shares in a client, being too dependent on client fees, and accepting gifts from clients. Owning shares in a client and auditing them could mean you have sensitive information available to your investment. If errors were discovered that reduced the profit, for example, you may not identify them to protect the return on your investment. You should therefore recommend that all shares are sold if taking part on an audit, or the individual should not be involved in the audit process. Being too dependent on client fees increases the need to keep them as a client. Auditors may therefore be too lenient with them and allow bias into decisions being made on the audit. The recommendations are that there are fee limits for clients within an audit firm. No more than 15% of total fee income should come from an individual client. This relates to recurring fees only, and regular fee review should take place on clients to ensure limits are not exceeded. Accepting gifts can be seen as a way to influence the audit. Auditors may want to please the client, so they continue to receive gifts which could affect decisions being made. The recommendation is to only accept modest gifts. If it is a small token, it is unlikely to affect the audit. Anything else should be politely declined. The auditors should also document any gifts offered on the audit file. Self-review threats include accounting and tax services, internal audit services, and if a client's staff join the audit firm. Provision of accounting or tax services is allowed as long as it is not a listed client. If listed, they must politely decline the offer. The same applies to internal audit services. If it is a listed client, it is not allowed. The general recommendation for provision of other services is, as long as it is not listed, separate teams should be used so individuals do not audit their own work. If a client member of staff joins the audit firm, they have a close connection to the client and may have personal feelings towards staff there which could affect their judgment. They could also technically be auditing their own work and may not identify mistakes made. It is recommended that they should not take part in the audit of this client for at least 2 years since their employment ended there. Familiarity threats include the length of time the client has been at the audit firm and family or friends working for the client. The longer the audit firm has worked with a client, naturally the less objective and more trusting they can become. The audit partner who is responsible for the audit should therefore be rotated on a regular basis to improve objectivity. 7 years is currently the recommended maximum that an audit partner should be working with a client. Family and friends working at a client would naturally cause problems for an auditor remaining objective and not allowing personal feelings affect their judgment. Therefore, the auditor should not take part in the audit assignment if they have family and friends working there. Advocacy threats include representing a client in court or any dispute, and negotiating on the client's behalf for finance. If representing a client to resolve a dispute or to assist in a court case happens, remember it is impossible to remain independent and work alongside them, speaking on their behalf. The same applies to negotiating on their behalf. The perception given by representing them means auditors would almost certainly not be seen as independent. The recommendation is that auditors are not allowed to act in this way. They must politely decline any offer of these services. Intimidation threats include overdue fees and litigation between clients and auditors. If fees are overdue, there is a risk the client is withholding fees to try and influence the outcome of the audit. The recommendation should be to discuss the issue with the client, then delay further work until the fee is paid. If there is a court case between the client and the audit firm, it is almost impossible to maintain a professional relationship and be objective during the audit process. The audit firm should therefore resign, as it is not possible to complete an audit assignment effectively. And so you should now have an understanding of the 5 threats to objectivity that an auditor may face, and also how to manage those threats if they arise. Our next step is to look at another ethical risk, conflicts of interest. A conflict of interest arises when the audit firm has the opportunity to audit 2 connected clients. For example, to audit 2 competitors or clients that are in a major supplier-customer relationship. This situation may arise if you have a client and due to your experience in that field you have been approached by the other client. It can also arise when audit firms merge together and they find that both parties have a client that is connected to the other. The main issue with a conflict of interest is confidentiality. Both clients will be concerned with sensitive information being leaked from one party to another, which the other client could react to. It is advised that audit firms should avoid conflicts wherever possible, but if a conflict is present, they should ensure sufficient safeguards are in place. The safeguards are as follows. The audit firm should discuss with both clients whether they are both happy to continue with the same audit firm. If it's a no, then they must decline the audit assignment or resign from one. If it is a yes, then they need to ensure confidentiality can be maintained. Having separate audit partners heading up the audit teams. Separate audit teams and offices, if possible, should be set up. Training on the importance of confidentiality should be given to all staff on either audit team. Confidentiality agreements can be signed by the audit staff to enforce the importance of not discussing the client data. If the audit firm cannot guarantee safeguards are strong enough, they should not continue with both audits. The final issue to discuss in this video is breaking confidentiality. We have discussed the importance of keeping client information confidential, and it is one of the fundamental principles from the ethical code which should be followed. However, there are instances where confidentiality can and should be broken. There are three situations with which we can categorise disclosing information regarding the audit client, and they are when the client has given permission to disclose, where there is a legal duty, and where it may be in the public interest. The client may give the auditors permission to disclose information about them to a third party. This may be part of the normal process of an audit. For example, when first accepting an audit assignment, a professional clearance letter is sent to the previous auditors. This asks for any professional reasons why the auditors should not accept the assignment. The client permission must be obtained before writing to the old auditors and responding back to the potential new auditors. Other independent parties may also be approached by the audit firm, including the bank. To confirm the bank balance, the auditors contact the bank asking for a bank report to confirm directly. Again, permission is needed before any contact is made with the bank. There may be a legal duty to disclose information about the client. This could be if there is a concern that they may be involved in any illegal activity such as money laundering. Before any disclosure is made, the auditors must ensure they have sufficient evidence to prove this and should seek legal advice first. The auditors may also be summoned to court to give evidence regarding the client. In this situation, the court takes precedent and they must attend and give the evidence required. The auditor may also find themselves in court defending themselves against a client, for example. In this case, the auditor has the right to provide information about the client to defend themselves rather than be silent. Acting in the public interest is important for an auditor to maintain the reputation of their profession. If they find the client they are working with is doing something immoral, they may decide to disclose this information externally. Examples could include environmental issues such as pollution, or the client not acting in the public interests. Caution must be taken as proving something is in the public interest is difficult. Discussions within the audit firm should include audit partners for additional advice, and even legal advice should be taken before any disclosure is made. To summarise this video, we have covered ethical risks relating to auditors. These were threats to objectivity, conflicts of interest, and breaking confidentiality. All three issues are addressed at the acceptance stage of an audit to identify how likely it is that these issues will cause problems for the audit process. Confidentiality is then an ongoing issue for the auditors and should be considered if any of the issues mentioned arise when working for the client. If the auditor's ethical behaviour would be affected during an audit assignment, they should consider whether they should continue working on the audit assignment, as ethical advice is in place to protect the reputation of the audit firm and the profession as a whole. I hope you found this video useful. Thank you for watching. This video is going to cover the topic of corporate governance. We are going to discuss the impact corporate governance has on external audits. We therefore need to cover what corporate governance is, what is needed for an organisation to follow corporate governance, the role of the audit committee, and what the external auditor reports on for a listed company. Corporate governance is a set of guidelines that listed companies should follow. It is quite simply advice on how to run your company well. The aim of corporate governance is to allow these companies to operate in the shareholders' interests and help protect their investment from poor management decisions. Globally, there are variations on corporate governance. We are going to focus on the UK version, which is the Corporate Governance Code. The Corporate Governance Code is a set of guidelines that should be followed by listed companies. Many non-listed organisations also follow them as they are deemed best practice. The code gives us 5 main principles. Leadership. That the board of directors are collectively responsible for the success of the organisation and decisions are made fairly. Non-executive directors who are part-time and not involved in the day-to-day activities should assist with decisions made. Effectiveness. The Board of Directors should have appropriate skills and be provided with the relevant information on a timely basis to ensure the right decisions are made. Accountability. The Board of Directors should ensure risks are identified and that strategies are formed while communicating openly with the auditors. Remuneration. Directors' pay should be fair and still be able to attract the right individuals to the role. Pay should not be set by one individual, and no one should set their own pay. And shareholder relationships. Communication should be clear and objectives and any issues should be dealt with on a timely basis. In practical terms, in order for these principles to be implemented, the company must organise the Board of Directors so that responsibilities are shared and decisions are made fairly. Heading up the Board of Directors should be the Chairman and the Chief Executive Officer, or CEO. The Chairman should be a non-executive director and lead the board to ensure strategic decisions are made in the shareholders' interests. The next tier of management would consist of executive and non-executive directors. Executive directors run the company on a day-to-day basis, and non-executives monitor and assist in decisions being made. Ideally, there should be an equal board mix of the two types of directors. This tier of management would then form committees who take on responsibilities for the company. The committees are the Audit Committee, the Risk Committee, the Remuneration Committee, and the Nomination Committee. The Audit Committee is responsible for financial reporting and system control matters. It should be comprised of at least 3 non-executive directors. 2 is permitted for smaller companies. At least 1 should have finance experience, which makes sense given the responsibilities they are taking on for the company. This committee should ensure that they increase confidence in the published financial information. They liaise and advise the Board of Directors to ensure they meet the responsibilities for providing financial information, and improve independence of the external auditor as they communicate directly with them. Some of the responsibilities of the Audit Committee include reviewing the internal controls and recommending changes, often with the assistance of the internal auditor, communicating with the internal and external auditors, reviewing the reliability of the financial statements, recommending the appointment and removal of external auditors, and arranging for a confidential whistleblowing system for employees and potentially investigate any issues found. As this committee improves confidence, credibility, expertise and the control environment, it is a welcomed recommendation for shareholders. It may be difficult to find the right individuals with the necessary skills, and these individuals may prove expensive for the company. The Risk Committee are responsible for assessing the risks associated with the company and recommending the best approach to reduce these risks. This committee is also made up of non-executive directors, whose role is to identify risks and ways to manage those risks. Once identified, they need to prioritise them in order of importance and then assess whether the risk can be transferred to another party, for example by an insurance cover, be avoided altogether, be reduced by improving controls, or, if not likely to happen and low impact risks, be accepted. Business risks must be reviewed and reported to the board regularly to ensure that they are identified in a timely manner. This is an ongoing process for the committee as the risks can come from the company itself and from external factors, for example, changes in regulations and economic climate changes. The Remuneration Committee set pay for the Board of Directors. Remember, the Corporate Governance Code recommends pay is not set by an individual and is fair but competitive. The Remuneration Committee is therefore made up of non-executive directors to ensure the executive directors are not paid excessive amounts, performance is considered in the decisions, and they are not setting their own pay. The Nomination Committee is responsible for appointing directors to the board. Once again, the board is made up of non-executive directors. This ensures the best person for the role is appointed and reduces the risk of bias in decisions being made on recruitment. Otherwise, personal feelings may be involved when recruiting directors for the company. If a company is listed or wishes to follow best practice, these recommendations should be followed. Listed companies then produce much more detailed financial information in their annual report. It will report on the Corporate Governance Code and whether they have followed all of the principles. The auditors must audit the financial statements, plus they must report and review the compliance of the Corporate Governance Code. The auditors must prepare their audit report and report on whether the financial statements are true and fair. This is based on performing audit procedures and gathering evidence on the systems, balances and transactions of the company. They must also report on any inconsistencies found with the other information in the annual report, including the director's statement. Any concerns with the information provided will also be included in the audit report. I hope you found this video useful. Thank you for watching. This video will cover internal auditors and how they impact on an external audit. To fully understand this, we are going to cover the internal auditor's role, the key differences between an internal and external auditor, how the external auditor can rely on the work of an internal auditor, who requires an internal auditor, and outsourcing the internal audit function to an audit firm. The internal auditor's role can vary depending on the requirements of the entity. They can cover a broad range of activities. Their main aim is to advise management. The internal audit team usually work within and report to the management of the entity. The expected role of an internal auditor includes the review of control activities. This would be a review of the control systems within the entity and would highlight any control deficiencies that may need to be addressed. This will assist in reducing the risk of fraud and error. To examine the timeliness of control information. This will enable management to react appropriately to information received from their systems. The internal auditor will regularly review systems and ensure issues are reported. Value for money audits. This is to identify whether a decision is appropriate for the organisation. This could include a new product, service, or even whether to go ahead with a new supplier. They will review the 3 E's: the economy, the best price, the efficiency, the best use of resources, and effectiveness, the best result, to help decide whether to go ahead with the plan. Identifying business risks. Internal auditors are best placed when reviewing the entity and its control systems to identify potential risks to the company. They will then report these to management and recommend how the entity can reduce that risk. They will examine compliance. Again, they have the expertise to identify non-compliance of laws and regulations. They can report these to management and assess how they can be avoided in the future. They work with and support the Audit Committee. The Audit Committee is a group of non-executive directors who manage external and internal auditors. If internal auditors report to this committee, they improve independence from the board and also very often improve the effectiveness of decisions made of their work. Finally, they complete special investigations requested by the entity management. This can include fraud investigations, mystery shopper reviews, inventory counts, and asset inspections. Each of these investigations will assist the management in improving the organisation. It is worth noting that internal and external auditors have some key differences. These are independence, scope of work, objectives, reporting, appointment and removal, and whether they are a legal requirement. External auditors must be independent in order for them to form an opinion that will be trusted by the users of the financial statements. Internal auditors, however, work within the organisation and often report directly to the directors. They therefore are not independent from the entity and may lack objectivity when performing their work. The scope of detail of what these auditors do is also different. The external auditor plans and performs audit procedures on the control systems and the transactions and balances within the financial statements. This identifies whether the financial statements are true and fair. Internal auditors, as we have already seen, cover many areas looking at the systems and controls used by the entity. The amount of work will depend on the requirements of management. The objective of the external auditor is to form an independent opinion on whether the financial statements are true and fair. This is provided in a written report at the end of the audit process. The objective of an internal auditor is to advise management and improve the control systems. External auditors report to the shareholders of the entity. Internal auditors report to the directors or the audit committee if available. External auditors are appointed and removed by the shareholders. This is done by vote, usually at the AGM. Internal auditors are appointed and removed by the board of directors or the audit committee if available. An external audit is required by law. There may be exemptions. For example, in the UK, there is a small company exemption which allows smaller companies to not carry out an audit, but all medium to large size companies will need one. Internal audits are not required by law. They are recommended by corporate governance to ensure sound control systems. External auditors may be able to use some of the work that an internal auditor produces. For example, the review of control systems to highlight deficiencies and testing of control systems is something that the external auditor carries out as part of their audit work. It may be possible to use some of this work with permission so that they can then concentrate on other more complex areas of the audit. Before they decide whether they can use the work of the internal auditor, they must consider how reliable it is. Considerations would be the scope of work. They would address how much detail has gone into the work, as external auditors must provide reasonable assurance on the work they carry out. The technical competence. They would need to review the experience and qualifications of the internal audit team. The report quality. They would need to identify whether there is enough written evidence to ensure it forms sufficient appropriate evidence for the audit. Independence. If the internal auditors report to the audit committee, this would improve independence and also how reliable they would be for the external auditor. Based on what we've just mentioned, the external auditor would then decide whether they can use some of the internal auditor's work as evidence. Not all companies require an internal auditor. For example, if the company has simple systems, is small in size and only one location, there is very little need to have the internal auditor support the organisation. There are some indicators of requiring an internal audit function, including if the company is large, if it has complex systems and regulations that must be followed, if it is listed on the stock exchange, if it has been known to have problems, for example, fraud or internal control deficiencies that led to fraud and error. Each organisation must decide whether an internal audit function would benefit them and fit in the plans for their future. If an entity would benefit from an internal audit department, but it is not prepared to have a full-time employed internal audit function, they may outsource. Audit firms have the expertise to take on the role of an internal auditor for the organisation. Many have internal audit departments with dedicated staff who work on assignments for these clients and assist the management with the role of the internal auditor. This setup has many advantages and disadvantages. The advantages are: it can be cost effective, as using an external audit firm to take on a short-term assignment would be cheaper than having an employed internal auditor or internal audit team. This option also removes employment costs such as recruitment and tax. Audit firms may have more specialised skills from the experience they gain with other clients. This means the company may benefit more from the work completed by an outsourced function. This option increases independence for the internal auditor. If the internal auditor is not employed by the management and working full-time, then their work may be seen as more reliable. It reduces the burden of having a department to manage. It will allow them to focus on more important areas. The disadvantages of an outsourced internal audit function are: they may lack the knowledge of the business to fully understand the whole operation. This may lead to them misinterpreting something incorrectly. They can be expensive thanks to the generous charge-out rates issued by the audit firm. Therefore, long-term use may become less cost-effective. They may not be available immediately. Due to other responsibilities, they may not be ready for the client when they need them, leading to delays in decisions. There is a possible conflict of interest if the audit firm carries out the external audit. Many countries will not allow this. For example, in the UK, ethical standards stop external auditors being the internal auditors if they are to place much reliance on the work during the external audit. We have covered lots of areas relating to our internal auditor. You should now understand the varied role of an internal auditor, how they differ from an external auditor, how the external auditor can often place reliance on the work of the internal auditor as evidence, and what they must consider before they do this, when an internal auditor is beneficial for an organisation, and how outsourcing the internal audit function to an audit firm works and what are the key advantages and disadvantages. I hope you found this video useful. Thank you for watching.